Hello everybody and welcome back to this video where we are going to focus on some of the top lithium producers in the world. We have today selected the following three: Albemarle here, stock ticker ALB, Sociedad Química Minera, stock ticker SQM, and Livent Corporation, stock ticker LTHM. So from a high level perspective, the difference between the three companies is that ALB and SQM is a bit more diversified. ALB has three main business segments. One of them is catalyst, then they have bromine, and finally they have lithium. SQM, the biggest producer in the world of lithium, also have industrial chemicals. They have iodine and they have plant nutrients, while as Livent Corporation, which is a spun off of FMC Corporation, a much larger company, is solely focusing on lithium products and solutions. So first we want to understand how these stocks have been performing, whether they're an uptrend or a downtrend, and as we can look across the board here, it's more or less only green numbers with the exception of the last week. So all of the companies are in an uptrend. If we look year to date, ALB has gone up with 86%, 71% for SQM, and LTHM is up with 87%. So really good gains over the last year, and more impressively over the last 6 months it has grown even further. We then want to start digging into the numbers and look at the income statement part, and we want to understand whether these companies are earning any money in the end of the day. So if we first take a look at the net income here for the last 12 months, we can see that it's positive for ALB, SQM, but negative for LTHM. They're losing around $14 million over the last 12 months, so that's a small red flag. If we look at the net profit margin, ALB is doing the best with 14%, 9%, also quite good for SQM when you benchmark with the industry, and LTHM minus 5%, so really not a good number for them. On the BNHM score, we want to look at the mathematical model that determines whether the company has potentially manipulated its profits. So we want this to be less than minus 2.22, and we can see ALB is good and LTHM is red with minus 2.13, but it's not a huge risk. We can also take a look at the Sloan ratio, which identifies as if a substantial part of the earnings are non-cash accruals. We are not interested in that, so we want this to be between minus 10 to 10%. Small red flag here, but nothing special for ALB, green on SQM, and again a little bit too high in Livent Corporation here with 19%. So here in the overall ranking, we first looked at the trend of the stocks and all of them were in an uptrend. On the net income part, Albemarle and SQM was positive, however Livent Corporation was negative. On the net profit margin, Albemarle was doing the best, followed by SQM, and of course Livent Corporation were the last one because they had a negative net income. We then want to investigate the return metrics and how high returns and cash flow margins is being generated by the companies. And if we first take a look at the return on invested capital here, benchmarked against the industry, all numbers are red, but ALB is doing the best with 5.3%, followed by SQM again 2.3%, and minus 5.2% for LTHM, so really not good. We can also look at the levered free cash flow margin. ALB again doing the best, although a minus on 0.9%, minus 1.3% for SQM, and Livent Corporation again doing really bad here with minus 63%. This is again a huge red flag for us. On the balance sheet and ratios, we want to understand how strong the financial position is of these companies, and we can first look at the current ratio and cash ratio. We want them to be above 1, and as we can see, green across the board, SQM and Livent Corporation actually has quite good numbers here, so that's positive to see, especially for Livent Corporation when you look at their results. On the cash ratio, we want this to be above 1, however all of them are in the red here, they're below 1. SQM doing the best, followed by ALB, and Livent Corporation is doing the worst. We can also look at the total ratio, total assets versus total liabilities. We want this to be above 1.5, and again all the companies are doing quite well here. Livent Corporation a bit surprisingly doing the best with 2.68, so that is good to see. Similar on the debt equity, Livent Corporation is doing the best, followed by ALB and SQM. We can also take a look at the Albemarle Z score, which is a credit strength test that assesses the likelihood of bankruptcy. We want this to be above 1.8, and all of them are living up to that. And Livent Corporations is doing the best. So again, no huge concerns on their financial situation, although they're losing money. We can also look at the Piotrowski score, which is another way to assess the strength of the company's financial position. We want this to be equal above 5, and we can see the only one not living up to this is Livent Corporation, who gets a 2, which is actually quite bad. However, Piotrowski score only looks at the last 12 months number, so we need to take them with a grain of salt, and we like Albemarle Z score a bit more than Piotrowski score. Back on the overview, and for an easier benchmark, when we first looked at return on invested capital, Albemarle was doing the best again here, followed by SQM. On the levered free cash flow, similar story repeated itself. Albemarle followed by SQM, and Livent Corporation had a really poor number here. On the balance sheet, on the total ratio, Livent Corporation was actually doing the best, followed by SQM and Albemarle, but it was looking quite well across the board. On the debt equity, close to the same situation, Livent doing the best, however Albemarle number 2 here and SQM number 3, but good numbers across the board in terms of balance sheet. No concerns with any of these companies. We then want to understand how much value is returned to shareholders through dividend and or buyback. And if we look at the dividend yield, we can see that ALB and SQM is paying a small 1.4, 1.5%, so nothing to be totally happy about, but it's not too bad either. Livent Corporation is not paying anything. On the buyback yield, we can see that ALB has issued a bit of shares over the last 12 months, whereas the others have not either issued or bought any shares back. That gives us a total shareholder yield, which is 1.3 for ALB and 1.5 for SQM. So again, nothing fantastic, but okay. We though want to understand the modified payout ratio, which shows the proportion of earnings that is paid to the shareholders in the form of dividends and or buyback. And this is an interesting metric because it shows whether the companies will be able to actually grow this without hurting their financials too much. So here you can see that ALB is only paying 40.6% versus SQM, which is paying 110%, which is in the long run is not sustainable. So ALB has much more room to actually pay out more dividend and or buyback to the shareholders. So in our opinion, it's actually a better option from this perspective than SQM at the moment. Next, we go into the earnings per share and growth, and we want to understand whether these companies are expected to grow in the future. We can first look at the price earnings ratio, and actually here ALB and SQM comes up a bit expensive here, especially SQM with 73.27, Livent Corporation only 23.92, so compared to the industry they actually look attractive from a PE ratio perspective. However, if we look at the earnings per share growth forecast for the next 5 years, we can see that ALB and SQM is doing again the best with around 15 to 17%, and Livent Corporation is only 6%. So although it's green compared to the industry, it is not as good as the competitors. What is really interesting for us to see with these companies is when we look at the revenue growth for the last 12 months, we can see that all of them has actually reduced the revenue. They have lost business, so that is not good. Again, Livent Corporation doing the best with 25.69 minus in revenue over the last 12 months. And if we look at the net profit growth, again, it has declined with 33% for ALB, 52% for SQM, and 120% for Livent Corporation. So really poor numbers. So we have a situation here where the share prices have skyrocketed over the last 12 months, but the revenue and net profit growth has actually not improved. So that is quite a concern for us with these companies, where there is a huge mismatch between these two numbers and how the share price has developed. Although, again, the stocks are obviously traded on future expectations, this is kind of like a red flag for us in terms of their share price as of today. So back to the overview, we looked at the earnings per share growth forecast for the next 5 years, and it was looking quite well for all of them. SQM, Albemarle by far doing the best. Livent was lagging a bit behind with only plus 6%. On the revenue growth and the net income growth, huge disappointing numbers across the board. Revenue has fallen for all of them, and net income growth has also fallen substantially over the last 12 months, and this is a small red flag for us. Finally, we obviously want to understand whether these companies are currently under or overvalued. One way is to look at the price earnings to growth ratio, the PEG ratio here. If, according to Peter Lynch, fair value, if it's below 1, it means that they are undervalued. If it's above 1, they're considered overvalued. And as we can see here across the board, all of these companies are considered overvalued. Albemarle is the least here with 2.52, but again, still overvalued. We can also take a look at my own estimated intrinsic value, which is based on a lot of different numbers, assumptions, and different factors. And based on that, I see an upside or downside on the companies. A downside on ALB minus 10%, SQM downside on minus 7%, and a minus 24% on Livent Corporation, so the one with the biggest downside according to my numbers. We can also look at the beta ratio, which just shows the stock's volatility in relation to the overall market. If it's above 1, it means that it's more volatile. If it's less than 1, it is less volatile. And we have the numbers for ALB, which is more volatile, and SQM is less volatile. We can also look at some other value indicators. One of them is the book value ratio. In this case, if it's above 1, it means that it's undervalued. If it's below 1, it is overvalued. And all of the companies are significantly overvalued from this metric. We can also look at the relative strength index for the last 14 days. We want this to be below 30 because it means it's oversold and there's a likelihood that it will go in an uptrend. Vice versa, if it's above 70, it is overbought and it may do a pullback. There's no conclusive information on any of these companies, but they are leaning more towards the overbought territory than the oversold. Finally, we can also take a look at the analyst recommendations. What are their perspectives? I just use them as a guideline. I don't follow it blindly because some of these analysts have their own agenda and you therefore need to be really cautious with using them 100%, but it's good to check and see if they matches our numbers. And if we look at the price target, which is just the consensus price, the middle ground of all the estimates, some of the analysts will have a higher price target, some of them will have a lower. However, in the middle ground, they see a downside on ALB on around 30%, 39% on SQM, and 25% on Livent Corporation. So they're much more bearish on ALB and SQM that I am, while as on Livent Corporations we are actually quite close to the analyst. But again, based on this, none of them looks that attractive from the current price. So again, by no surprise, if we look at the overall value assessment based on all the factors that we just looked at, we believe that all these companies are currently overvalued. So finally, which of the stocks do we like the best, although all of them are overvalued as of today, according to us? Well, we want to start by saying that we actually think there's a good long-term outlook on all these companies because they are producers of lithium, which we expect will have increased demand in the future, so that will be beneficial to them. However, in the short term, we think that these companies are overvalued and they may see a small correction at some point. However, if we should say one that we like the most, it will be Albemarle, stock ticker ALB. It is overvalued based on the numbers. However, they are the company that overall has the most solid numbers, and we have a quite good feeling with them long-term wise. They also have a relatively diversified business, so they're not only dependent on the lithium part. The next one is SQM. Looks a bit more expensive than ALB according to us, but they also have relatively solid numbers and we also have a good feeling with them long term, but not in the short term. The one we like the least is Livent Corporation. It's the worst performing of the three stocks if you look at the numbers. They are still not profitable, and for us the outlook for them looks a bit blurry, both from the EPS perspective but also on a revenue and net profit perspective, where it has decreased significantly. So again, this doesn't mean that Livent Corporations is a bad buy in the long term. However, we just like the two other companies a bit more than them. This was all we had for today. Please subscribe for future content. Please give us a like, it helps with the algorithm. Please provide a comment in the comment section. We always appreciate your input. We do not know everything, so it's always good to get some feedback from some people who also have experience within this area. Otherwise, there's not much more to say than have a great day, stay safe, hasta la vista baby.